Welcome back to the Degens Journal, where the world of crypto, politics, and tech collide at full speed. Today's headlines are packed with regulation breakthroughs, ETF drama, and $10 billion power plays. If you're here for the alpha, you're in the right place. Today's headlines: Kraken and Robinhood launch the global dollar, USDG, in Europe under MiCA regulation. Elon Musk secures $10 billion for xAI as Trump threatens to unleash Doge. Malaysia proposes easing approval process for listing crypto assets on exchanges. Trump's Big Beautiful Bill hits gridlock as senators pack it with crypto clauses. Analysts raise chances of SOL, XRP, and LTC ETF approval in the US to 95%. Let's dive in. Story 1. Saylor just dropped $531 million on Bitcoin. Again? Michael Saylor isn't slowing down, he's doubling down. Last week, while headlines focused on short-term volatility and macro jitters, Strategy, the Bitcoin-heavy holding company chaired by Saylor, quietly executed one of its boldest moves yet: a $531 million BTC buy, adding 4,980 coins to its already massive treasury. The kicker? This wasn't just well-timed, it was surgically timed. Bitcoin surged from $101K to over $108K during the same week. Strategy bought in at an average price of $106,801, showing Saylor isn't just making big bets, he's reading the market like a hawk. Here's where things get wild. Strategy now holds 597,325 BTC. That's over $42.4 billion in total value. Acquired at an average cost basis of $70,982 per coin. Let that sink in. Saylor's not playing crypto games, he's executing monetary warfare. This isn't about quarterly profits or price targets. This is a philosophical bet that Bitcoin isn't just digital gold, it's corporate sovereignty. BTC is no longer just an asset on the balance sheet. It's becoming the balance sheet. Saylor isn't just stacking sats, he's building a private central bank, one block at a time. While Wall Street argues over ETFs and central banks debate CBDCs, Strategy is doing what institutions eventually will do. Buying Bitcoin not because it's speculative, but because it's inevitable. Story 2. Chainlink's ACE could unleash $100 trillion. Here's how. It didn't get the fanfare it deserved, but this may be one of the most important crypto developments of the year. Chainlink, the decentralized Oracle network that powers cross-chain data, has launched ACE, the automated compliance engine. Its goal? To unlock the $100 trillion locked behind institutional walls. Let's be clear. Institutions want in, but the problem isn't price, it's compliance. They can't touch DeFi unless the rails are clean, regulated, and auditable. That's what ACE delivers. Modular compliance architecture that adapts to evolving regulations, on-chain enforcement that automates rules at the protocol level, cross-chain settlement, so capital can move frictionlessly, reusable digital identities built for both privacy and compliance, regulated asset usage across both CeFi and DeFi. Chainlink isn't just building oracles, it's building a compliance layer for the programmable economy. Here's the real play. ACE is in early access for select institutions, but once proven, it becomes a de facto standard, the bridge between Wall Street capital and Web3 innovation. Think about what that unlocks. Sovereign wealth funds entering DeFi, tokenized securities, trading 24/7, real-world assets operating under smart contract control. This isn't hype. It's infrastructure for the new global financial stack. If ACE works, it won't just bring liquidity. It will bring legitimacy, and that's when the floodgates open. Story 3. JP Morgan hits Circle with a harsh reality check. Circle, the issuer behind USDC, and one of the original pillars of stablecoin legitimacy, just got a cold dose of Wall Street skepticism. In its first ever coverage report, JP Morgan slapped Circle with an underweight rating, assigning a $80 price target by December 2026. That's a 55% downside from its current valuation of $180. This wasn't a random downgrade. JP Morgan's logic was clinical. A 45x multiple on projected 2027 earnings per share, plus $10 of upside premium. In other words, modest expectations in a market that's rapidly changing. Here's what's really happening. Circle was once the default stablecoin infrastructure trusted by TradFi, integrated into CeFi, and everywhere in DeFi. But that moat? It's shrinking, fast. Every major bank is racing to launch its own programmable dollar. Every DeFi protocol is experimenting with protocol-native stables to reduce reliance on third parties. Meanwhile, Circle's biggest use case, USDC on Ethereum and Solana, has been fragmented by competition, regulatory uncertainty, and falling yields. So while Circle still has strong partnerships, early mover advantage, solid compliance infrastructure, it's no longer alone. The question now isn't, is Circle strong? It's, is Circle defensible? This downgrade is a reminder. In the stablecoin wars of 2025, brand isn't enough. You need distribution, regulation, and relentless execution. Story 4. South Korea freezes its CBDC as stablecoin fever takes over. What just happened in Seoul might change the global CBDC narrative. The Bank of Korea has officially paused its central bank digital currency, CBDC, pilot, a project that's been quietly running since April. The reason? A sudden surge of private bank stablecoin activity and a crypto-friendly government that isn't slowing it down. Let's break this down. Newly elected President Lee Jae-myung won on a pro-crypto platform, explicitly supporting stablecoin innovation. Story 5. BNB chain just got way faster. Maxwell upgrade slashes block times to 0.8s. BNB chain isn't just scaling, it's sprinting. This week, the Maxwell hard fork went live, and it's already delivering what it promised, a dramatic reduction in block time from 1.5 seconds to just 0.8 seconds. Let's be clear, that's not a small optimization. That's nearly doubling the speed of the entire network. So, what does that actually mean? 1. Real-time DeFi is closer than ever. Shorter block times mean lower latency, which translates to faster transactions, fewer stuck swaps, and more responsive trading platforms. For DEXs, lending protocols, and derivatives platforms, this is a game changer. 2. Bigger scaling capacity. With more blocks per minute, the network can process more transactions without clogging exactly what's needed for global adoption and enterprise-scale dApps. 3. Validator efficiency. Validator sync and coordination, a core part of any blockchain's security and speed, also just got smoother. This upgrade tightens the feedback loop and reduces slippage between state changes across nodes. 4. Better UX, less bottleneck. End users will feel it too. Shorter wait times for confirmations, more responsive apps, and less friction when moving assets or minting NFTs. That smoother UX? It's exactly what's needed to onboard the next million users. Bigger picture, why it matters. BNB chain has always been a volume monster, consistently ranking among the top chains for daily transactions and active wallets. But critics often dismissed it as fast, but not fast enough. No? With this Maxwell leap, it's no longer just a high-volume chain. It's a high-performance chain. Faster than Ethereum. Cheaper than Solana. More consistent than Avalanche. In a multi-chain world, these seconds matter. Especially as L2S and app chains fragment the ecosystem, raw execution speed becomes a core differentiator. And Binance knows it. Maxwell isn't just an upgrade, it's a signal. BNB Chain is positioning itself to be the go-to platform for real-time finance, scalable dApps, and global DeFi infrastructure. This isn't about TPS bragging rights. It's about giving builders and users a chain that feels instant and just works. While some still argue whether Bitcoin is money, Michael Saylor just dropped another $500 million. While central banks hesitate, South Korea is leaning into stablecoins. And while mainstream headlines still scream, "Crypto winter," Chainlink is building the rails for $100 trillion to flow in. This isn't the future. This is happening now. and you're watching it from the front row. If you want to stay ahead of the curve beyond FOMO and memes, hit that subscribe button. Every week, real signal, sharp insights, and the stories that actually matter. See you in the next episode of Deegan's Journal. What's driving this momentum? First, the SEC's final deadlines for decisions on the individual altcoin ETFs are set for October 2025, compressing the timeline and forcing regulators to act. Meanwhile, institutional appetite for regulated crypto products has surged, with major players clamoring for trustworthy, compliant ways to gain exposure to high-growth tokens beyond Bitcoin and Ethereum. If these approvals materialize, the impact on the crypto market could be profound. Increased liquidity. ETFs tend to bring massive inflows of capital, enhancing trading volume and reducing spreads, making it easier for investors to enter and exit positions. Mainstream legitimacy. Regulatory sign-off would provide a strong endorsement, helping dispel lingering skepticism and attracting conservative investors. Market expansion. A regulated altcoin ETF market in the US would unlock trillions in potential capital, fueling innovation and ecosystem growth. In short, ETF Summer 2025 is officially here, and it could mark a pivotal turning point in the journey of altcoins from fringe speculative assets to mainstream financial instruments. Investors, institutions, and regulators alike are watching closely, as the decisions in the coming months could reshape the very structure of crypto investing in America. The pace of change in crypto is going exponential, stablecoins going global, altcoins going institutional, and AI taking billion-dollar bets. If you made it this far, drop a comment, Global Mode Active, so we know you're locked in. And don't forget, if you're enjoying the ride, smash that like, hit subscribe, and we'll see you in the next edition of the Deegan's Journal. Stay degen, stay sharp.